Hello and welcome everybody. Happy Friday. Hopefully everyone has had a lovely week and is ready for the weekend. I wanted to go back today. We've talked a lot over the past almost 6 months together about different topics, different investment types, different ways of investing, but today I want to take it back to basics. I want to go back to where a lot of this conversation started and talk not just about what type of charts we look at, but refresh everyone on why we look at them, why these charts are good, how we read them, and then how these charts can be used for things other than just viewing the price of a company. So that is the goal for today. So before we get started, as per usual, I want to go through and welcome everyone that we have with us. Hello, Blaze, the first person with us today. Riley, Nancy, I'm glad that you were able to see all the webinars. Chela, Janeth, Eddie, Erika, Yesenia, Romulo, Fidelia, Lily, Kike, Sylvia, Berta, Rocio, Maida, Wendy, Magnolia, my mother. I think I already, I got Lily. Consuelo. Lots of new faces today. Ana M, Ana C, Rosa, Claudia, Chela, Cortinas, Luis, and Nube. Welcome everyone. Thank you so much for being here with us today. Let us get started with the topic for today, which again, if today's review, that's fine, but I really want to make sure that everyone is on the same page when it comes to what these charts are and how we read them, because the information they provide is incredibly useful, and I don't want that to be kind of muddied by the fact that we've had so many different webinar topics. So today is all about point and figure. So like I said, we're going to start over and go through what point and figure is. So something that should be a little bit of review for everybody is what point and figure means. It is a way of seeing how the price of a stock has changed over time. Hello, Alma. And hello, Jorge. And Rina. And Solucion. So point and figure is a way of looking at the price of something over time, whether it be a stock, ETF, whatever it might be. But instead of it just being we have 1 point per day, so every day we put a little new point into our chart, this is a little bit different. Here we're not looking at each point being a day. Each box isn't 1 day. We're instead looking at price changes over time. So we don't care if the price of a stock didn't change for a week, it just stayed at, say, $100. We care when it goes from $100 to somewhere, whether it goes up or down. So because of this, we only want to draw new boxes, or we only add new X's and O's when the price rises or falls below a certain price. Now, again, what that means is that we only add pieces of information to this chart when there is enough price movement that it matters, when we need to add new points. So what this results in is we have periods of nothing, where, the market may just have a flat day, flat week, and that's normal. The market is not going to make a millionaire or break a millionaire in 1 day. Hopefully. But what will happen is we will see prices not change for a while, or change maybe a little up and down, but what we really care about is when there is a change that is meaningful, when there is a big change that results in us wanting to either buy, sell, or just keep a closer eye on it. So how do we read these charts? It's not a giant game of tic-tac-toe. There is some order to it. So let's look at that. The numbers on the right and left side of the box, or of the chart, are what is called boxes. Each one of these boxes is not a single price. It is a range of prices. So if we see here where the blue arrow is, it's pointing to 76. So the bottom of that line is 76.0000000000, and the top of that box is 76.9999999999999. So it is all prices between $76.00 and $76.99, repeating of course, cents. So when the price then goes to 77, now we go into this box that says 77. So again, these boxes are price intervals. They're not a single price. It is a range of prices. And depending on what that number is, the box size can change slightly. So to show this a little bit clearer, let's look at this chart. On the right hand or on the left hand side here, we have all of these numbers. We have 76, 77, 78, 79. It's going up by $1 every time. But look what happens here when it gets to $100. From $100 up, we now have 100, 102, 104, 106. So we went from $1 per box to $2 per box. So now, this 100 is all prices, so it is any price between $100 and 0 cents and $101 and 99.9, repeating of course, cents. So it is now $2, not just $1. Why? Why confuse us by having the numbers change? Well, the reason is because it helps us keep the significance, or it makes the boxes be more important. Because say you have $1,000 and I say, here's $10, go buy some lunch. $10, if you compared it to $1,000, is 1%. That's not very much, you know, if I had $1,000 and I dropped $10, I wouldn't be too worried. But if I had $50 and you gave me $10, now we're talking. Now this is a lot more money. It's still $10. The amount of money didn't change, but because it was $10 extra when I only had $50, it meant a lot more to me than if I had $1,000 and you gave me $10. So that is why the box size changes. It's because we want to be able to see not so much each box being $1, but we want the box to mean something. And we want that meaning to still be there when the price goes up. The last thing I want to show you is that here we see a little red number. That is the box that we are in. So the current price of XLV when I took this chart was $100. Was in the $100 box. But if we look over on the right side of the chart, this tells us the current price. So while we are in the box from $100 to $102, our current price of this fund is $100.95. So now, how do we actually? I've talked about what these boxes are. Cool. how do you actually use these charts? How do you see the price on these charts? Hi, Maida. Good to see you. And hi, Gisela. So what we see here is columns of X's and O's. So X's are always going up. O's are always going down. So again, if the price is going up, you would see it be a column of X's. And when the price is going down, you would see a column of O's. So we add a new box when the price, if we're in a column of X's, if the price goes up one box. So if it's going in the same direction as our current column, we only need one box. If we want to go from X's to O's or O's to X's, it takes a little bit more to knock us off of our train. So we need 3 boxes or more. So looking at this chart here, we see that we're currently in the box of $100. So again, we would stay in this box as long as our price is between $100.00 and $101.99.99999. So again, as I just quickly said, column of X's is going up. X's go up. O's go down. So to add another box to the same column, so if we have a column of X's going up, to add another X right on top, all we need to do is have the price go into a new box. However, for us to go from X's to O's or O's to X's, we need a little bit more than just one box. We need 3 boxes or more. Let's look at an example together to see this a little bit more clearly. Say Juan de los Palotes has a ETF, and the Juan de los Palotes mutual fund, I have an obsession with mutual funds today, ETF has a starting price of $168. Now, we had a really good day in the market. The price went up to $177. So our chart would look a little something like this. So we see our price here started at $168 and it went up. So it went up from 168 to 177. But 177 isn't its own box. Where is it? Well, remember, this box that says 176 is all prices from 176 up to the box above it, 178. So we have our price. If our price is 177, we would now be in this box here because 177 is above 176, but not above 178. Now, like I said, we would draw boxes up to the 176 box. Now, tomorrow happens, we have another good day in the market. Our price goes up to $179. So again, to add another piece to our current puzzle, to add another piece in the same direction, we would need to have the price go above 178. 179 is above 178. So we would draw an X up to the 178 line. Now, I didn't have a good day in the market. Juan de los Palotes ETF went down a little bit. So the price goes down to 175. What do we do now? Well, let's see. Remember, in order for us to reverse to go from X's to O's or O's to X's, so in this case, to go from our column of X's going up to our column of O's going down, we need to have a reversal of 3 boxes or more. So that would be 1, 2, 3. So the price would need to go to the box of 172. So let's draw that line. If we go below this red line, we would reverse into a column of O's. So where is 175 here? 175 is still right here in this box. It's above 174, below 176. So we do nothing, because we need to go below 174 in order to reverse from a column of X's to a column of O's. Now, the next day goes by, we recover a little bit, and the price goes up to 179. Now here, we didn't go to 180. We're still sitting right here at the 178, so we do nothing. There's no new point on the chart. Now, the price goes down to $173. 173 is between 172 and 174. So it would be right here below our red line. So because of that, we would reverse into a column of O's. And the chart would look just like we see here. So remember, anytime we want to go from X's to O's or O's to X's, we need to have 3 boxes or more. And here you can see them. 1, 2, 3. So now we have a column of O's. Can anybody tell me, if this was now the chart, what price would we need to go up to in order to reverse back into a column of X's? So remember, we are now in a column of O's, and we need at least 3 boxes in the opposite direction to switch from O's back to X's. So what price would we have to get to in order for us to go back to a column of X's? Seeing a lot of 174s, a couple of 178s. Some 176 and 182s for a little bit of spice and everything nice. 178 is the correct answer. So again, we need to have 3 boxes in the opposite direction. 174 would be box 1, 176 box 2, 178 would be the third box. Blaze, you're exactly right. Also, it's good to see you. It's been a while. You're from student to investor classes, right? That name sounds very familiar.
He's the 12-year-old.
What's up?
No, he popped in earlier webinars. He was the 12-year-old.
Thought I recognized the name. So yes, 178 would be where we need to go to, because that would be 1 at 174, 2, 176, 3, 178. Now we've talked about price. Let's talk about time. How do we tell time on a point and figure chart? Because again, there may be a month, 2 months, 3 months that we have no information for. It's not that the market closed and this stock went on vacation for 3 months. It's that there wasn't enough price for us to care. So how do we actually tell the time on point and figure? Well, down at the bottom, going from left to right, just like you would read a book, we have 100, or we see the 19. 19 means 2019. Then over on the right, we see 20. That is where 2020 begins. So the year is down at the bottom from left to right. And then the month is shown in the chart itself as red numbers and letters. Now, keep in mind that the letter does still count as an X or an O. So this one, where you see the blue arrow pointing to, is January. But it's still an X. The 2 above it is still an X. This 3 is now an O, so on and so forth. So, to quickly show you, January is 1, February 2, March 3, everything makes sense until we get to October. Now, 0 would be a really bad thing to use because 0 and O, they kind of look the same. So instead, people were smart and they said, okay, we've ran out of numbers. Let's go to letters. So we did. We chose A for October, B for November, and C for December. Let's look at our chart here and see if we can follow 2019 in this chart. Here, where the blue arrow is the start of our year in January. We go up to February. Then in the start of March, we go back down, then back up again. April down, back up. May a little up and then a little bit more down. June, starting to improve. July, yeah, we're not improving. August, bounces up and down. September, up. October, down. Then up again. November, up more. December, up a little bit more. And hey, we're back to January. So I want to show you something very important here. Here, we had August. August was 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 10. So it was 10 boxes and 1, 2, 3 reversals, all in August. So there was a lot of stuff happening in August. So what do we have here in February? We only had 1, 2 points. So this shows you February of 2019, there wasn't much happening, so no need to waste our time with that. August is where the good stuff was happening, or where a lot more stuff was happening. So we give August a little bit more of our attention. So these charts are fantastic for showing you months where a lot of action happens, like March of this year. Never said the action was good, I just said that there was action. Here we can see what happened in March. The price went up, and then tumbled down over time before starting to recover towards the end of March into early April. So that is how we tell time on point and figure. Now, the moment you've all been waiting for, what are chart patterns? All right, that may not have been the question you were asking, but it's the question that I want to tell you the answer to because it's important. So, the great thing about point and figure is it's not a day-by-day chart. It is a chart that is only changed when it matters. So because of that, it's very easy to find important things or milestones in these charts. What important milestones could that be? I'll give you two pretty simple ones: buy signals and sell signals. We can use point and figure to find buy and sell signals. And before I go any further, we are going to talk about chart signals here. These are not promises. Just because a chart tells you it's a buy signal doesn't mean you're guaranteed to make profit, and I'll show you why later. Just like a sell signal doesn't mean that it's suddenly going in the toilet and we just need to flush the drain. Stocks can change, and sometimes without a good reason for doing so. So just because the stock goes on a buy signal doesn't mean that it will keep going up. Just because it goes on a sell signal doesn't mean it's going to keep going down. Past results cannot guarantee future performance, but there is a reason that we can say buys and sell signals, because over time, history has shown that this does work. So, and yes, this is for educational purposes only. So, let's talk about this. Our buys and our sell signals will be where our short-term direction, which is the column of X's or O's that we're currently in, turns into long-term trends. Or it is when something new happens, something important happens. And our charts are always in either a buy signal or sell signal, whichever one is the most recent event, whatever one has happened most recently. So again, a stock will be in a buy signal until it's in a sell signal. Then it'll be in a sell signal until it's in a buy signal. And these signals can be used in investment decisions, finding a potential buy price and seeing when that buy price is hit, or as part of other math pieces, such as bullish percent. More on that in a little bit here. But let's talk about this in a bit more detail and go into what a buy signal in point and figure actually looks like. So a buy signal is when a column of X's goes above the previous column of X's, or when the price breaks what's called a resistance barrier. Let's see an example of this. Here, Juan de los Palotes ETF, we see the prices from December into January. Very real, not real at all. All right, so what do we have here? We have the price goes up in this column on the left column of X's. It goes up to the $166 box. Then we reverse down into a column of O's. So what does this mean? This means that the price was going up, and when it hit the $166 box, it ran out of steam. Investors thought, all right, you know what? It's not worth it to me anymore. This price isn't worth it to me. So it starts going back down. So what we get is we get a resistance barrier, because it's where the last time the price got up to $166, it ran out of steam. So let's draw a line there. So we saw how high it could jump. It went up and tried to make a little mark as high as it could go, and then it went back down. But now we know what it's capable of. We know what happens when it jumps. So what we get now is the resistance barrier above where it last was. So above that previous column of X's, or between the box of 166 and 168. So now, our buy signal, or rather the buy signal for point and figure, is when the price goes above this green line, or when the price goes above $168. So we jumped up, made a mark as high as we could jump, went back down. All right, let's see if I can try and jump even higher. Now I jumped higher, maybe I got some new Nikes, not a sponsor. I got some new Nikes and I could jump 2 feet higher, mark even higher. That right there, we have broken past the resistance barrier, which was how high we could jump last time. Something has changed. I got a new pair of shoes. The new pair of shoes helps. Maybe I grew 6 inches since then. You never know. I don't need to grow anymore, no. But I did have a massive growth spurt, which I may have been able to mark a little bit higher. But the buy signal is when we go above $168. Because now we get our double top breakout, is what this is called. So it's our column of X's above the previous column. Let's not stop there. Let's talk a little bit more about this, because what we see here is, it could just be random. It could just be a coincidence, a coinkydink, as I would have said it. So we actually have a little bit more information. We have more ways of being able to say how strong of a signal is it. So we measure this in 2 ways. How many times the price has reversed at the resistance barrier. So how many times did I jump up trying to make a higher mark, but couldn't? Because now, when I finally am able to reach up and make a mark higher, wow, it took you 4 tries, but you finally broke above it. That now means a lot more than if you just tried once, then tried again and got higher. So this is what we call different types of breakouts, such as a triple top breakout or even a quadruple top breakout. And I'll show some examples of these later on. So how many times the price has reversed is important, but also how long it's been since we've broken above that resistance barrier. Because sometimes we may have a stock that doesn't break above its resistance for months. So when it finally does break above it, something's changed, You went away for summer vacation, came back, and little Johnny grew up 5 inches. Or maybe he just got a new pair of shoes. Either way, now something's changed and we've broken above that resistance barrier. That matters, and that means something. So we have what are called spread triple tops, or even bullish triangles, which I'll talk a little bit more about those because it's very, very interesting. So let's look a little bit more at what happens. So remember, our price breaks above a resistance barrier after 2 reversals, let's say. That's what's called a triple top breakout. So here we see it jumped up once, stopped above the 128, below the 130, and turned around. Jumped up again, went back down, jumped up again, and now has finally gone above the $130 mark. So again, the more reversals at the barrier price, the stronger the signal is when it finally breaks out. Now, to the second point, the longer a resistance barrier has been set but not passed, the stronger the signal is when it is. So what do we have here? We have 4 columns of X's. 1, 2, 3, 4. The first column goes up and bounces back down and sets our resistance barrier below $130. It goes up again, bounces back down, goes up, but doesn't get all of the way to the resistance barrier. It turns around a little bit early, but that's okay. So what we have now is 2 different things. Above this column of X's, above this short column of X's, we have a double top breakout when the price goes above $128. So that would be signal number 1 that something is happening. What I like to call confirmation, or signal number 2, that's saying the same thing as signal number 1, is when we go above that $130 mark. Because now something's changed, we have some new information, and something's different. And the other thing that I want to show you is what's called a bullish triangle. It is when you have columns of X's and O's that are reversing, getting shorter and shorter every time. Hence the name triangle. And then if it's bullish, which bulls always go up, bears swipe down, our bullish triangle breakout is the horns going up and us having our column of X's break out of that triangle. But the same thing could happen on the sell signal side if this column of O's decided to go down. So again, the longer a resistance barrier has been set but not passed, the stronger a signal it is when the barrier is finally passed. Now we've talked about the buys, let's go look at the sells. And a lot of this should be familiar because it's the same thing as the buys, just on opposite day. So here we have a sell signal where we have a column of O's that goes below the previous column of O's. But instead of calling it a resistance barrier, we're calling it a support barrier. It's now not the ceiling, it's now the floor. So again, here's an example of a support barrier. Our first column of X's here goes up to $92 and then reverses down into the 89. So now we draw our resistance barrier below the $89 mark. So, and I apologize, this should say sell signal is given when the price goes below $89. So we see in the column that starts with a 2, the price goes down, hits the $88 box, which triggers our double bottom breakdown, which would be a point and figure sell signal. And just like the double top breakouts, the double bottoms are, or the sell signals rather, are measured in 2 ways. How many times we hit the barrier, triple, quadruple, so on, and how long the resistance barrier has been set but not passed. Again, same ideas. Spread triple bottom breakdown and bearish triangles. So let's, this is not the right slide. So now I want to show you what I was talking about before, where just because it says buy signal doesn't mean suddenly that the market is guaranteed to go up and the stock is going to go up with it. Things in the real world work differently than how we would like them to. Often what will happen, again, not guaranteed, there is never any guarantees, but what can frequently happen is we have in this case, a triple top breakout. So the price goes up, reverses back down, up, back down, up, and now breaks out one box above. So because many investors out there pay attention to Sectors Made Simple and listen to what we have to say, they know about triple top breakouts. So what they do is they say, when the price goes above $130, buy me $10,000 worth of Juan de los Palotes ETF. So now what happens is this. When the price goes above $130, all of the people that were looking at point and figure all start trying to buy immediately. A bunch of people start trying to buy, and there's not really that many people selling. So what will happen is the price will go up one box. All of those buy orders start coming in. And then there's not enough sellers to meet all the buyers. So when there's too many buyers and not enough sellers, the price goes back down. So what will happen is the price will immediately go one box up and then go straight down. Because all of those buyers are still trying to buy. Sellers, they're not changing what they're doing. So the price will tank. And this is what's called a bull trap. It takes all the investors that tried to take that triple top breakout and flips them on their head. So again, it is a triple top or any type of breakout where we go one or two boxes above the resistance barrier and then immediately reverse down into a column of O's. And this is often the result of sell-offs occurring at the buying influxes. Too many people coming in and buying, coming in at the resistance barrier, where people may want to take out their profits, but a lot more people are going to be trying to buy in because they see a buy signal. They want to buy on a buy signal. So what will happen is exactly what we see here. But don't take my word for it. Let's go see if we can look at some point and figure charts to prove this. But before that, I want to talk about one more thing that uses point and figure. Bullish Percent. Bullish Percent uses point and figure too. Where what it does is it goes to every single company and says, are you on a buy signal or are you on a sell signal? And it counts the number of companies in that market or in that index that are on a buy signal. So the Bullish Percent Index is the number of stocks on a buy signal divided by the number of stocks in the market. So say we have, 500 stocks in the S&P 500. And we have 350 stocks on a buy signal. We're going to do 350 divided by 500 times 100 because we like having a pretty number and we don't like decimal places. We don't like point something somethings. We get 70%. So if 350 companies out of 500 are on a buy signal, the Bullish Percent Index for that market is 70%. And these BPIs can be found for a number of different things. We can find them for markets, broad exchanges like the New York Stock Exchange, for example. We can find it for indexes like the S&P 500 or like the NASDAQ 100 or anything like that. And we can also find it for our sectors like the utility sector, industrial sector, so on and so forth. And for all of these, it's going to always tell us the exact same thing. The number or percent of stocks in that market that are on a buy signal. And what do we do now? We keep track of that percent over time and put it on a point and figure chart. And what this ends up giving us is an indicator of the risk in a market. Risk is in little quotations because there's no one number that will tell you the risk of a market. It's not, sadly, that easy. But it's a great way of knowing, are there still more companies that can go on buy signals? Or is everything already on a buy signal and the only place to go from here is back down? So what we do is we track BPI over time. We end up putting it on a point and figure chart, but instead of price, we have the percentage. And this chart always goes from 0 to 100% with boxes every 2%. So with this, we follow the exact same rules as normal point and figure charts would. Here we see a BPI chart, 0 down at the bottom, 100 up at the top, boxes every 2%, and the same rules for reversals. For a new box to be added, like you see this green box right here, we only need one box in the current direction. To go from X's to O's or O's to X's, we need 3 boxes or more. Now, I'm going to go look at some examples of all of what I've talked about right now, show you some different resources for them. But if you guys have any questions, feel free to let me know. I'm reading the chat, Kira's reading the chat, and we can help answer any questions you may have.
The 2 questions from earlier today?
Yeah.
I've got them.
What were those questions?
Hi, Jonathan. Can you please tell us your opinion about ARKK ETFs? Could be at the end of the webinar. Thanks so much.
So ARK is an interesting family of ETFs because they are not passively managed. So if you go back to our video that we talk about different kinds of funds, we talk about passively versus actively managed mutual funds. Or sorry, not mutual funds, ETFs. So this fund will follow a specific market or specific index. If I recall correctly, ARK specializes in emerging technologies. So it may have been VR, it may have been microconductors or superconductors when those were the new big thing. They like being on top of the new technology that's coming out. But it is an actively managed fund. So with that, there's 2 things that will happen. One, there is someone who's going to be managing the buying and selling of companies in that portfolio. It's not as simple as buy a broad market index. You're buying somebody's investment knowledge. And because of that, what you're going to end up having is slightly higher expense ratios. Because there's someone whose job it is to go in and manage that fund, that person needs to make a living. So they make a living from the expense ratios or the fees that that mutual fund charges. So they will charge a higher fee than if you went with a broad index fund like a technology index fund or something like that. Can I analyze Moderna, the point and figure chart, and look at that? I can, but let me just go through really.
One more question from previous.
Okay.
Jonathan, what is your opinion about the cannabis sector? Do you think it is the next boom?
The cannabis sector in Canada has performed very well since the legalization. However, in the United States, it's still a very difficult market simply because it's not legal. So because of that, while it is legal on state levels, which means that states can authorize people to buy and sell marijuana, the biggest problem is that they cannot apply for federal loans. They cannot apply for any sort of federal funding, federal tax breaks. They have really weird tax laws when it comes to paying federal taxes. So there is a lot of hurdles that those companies have to go through in order to really be as profitable as we would like them to be. However, there are a number of ETFs that mostly deal in the Canadian cannabis market, but it is an emerging market in the United States as well, and many of these Canadian companies are still tradable on the US exchanges. I will show an example of one of them with a very appropriate ticker symbol, weed. So this is a cannabis company that has a publicly traded stock that you can go out and buy and sell. So there are options available, but in the US market, it's very difficult simply because the federal government still does not like these kinds of companies. So let's go quickly look at mRNA, and we'll find some double top and all of those kinds of breakouts. So before I talk about anything here, this is all my opinion. We are talking about Moderna, which is a company that is currently working on a vaccine for the coronavirus, for COVID-19. So because of that, their price will jump up and down based on the news. If their vaccine trial has success, it will skyrocket. If their vaccine had a setback or was not as successful, it's going to tank. But also, when others get good news, when their competitors get good news about their vaccines, Moderna is going to suffer. Not because Moderna is doing poorly, but because they're not doing as well. So what we see here is some really interesting chart patterns. I want to take this right here as a great example. That's an arrow. I want a line. So right here, we have our spread triple top breakout. We have one, be a 2. Thank you. 2. Oh, come on. 3. And then 4. So here we have our spread triple top breakout, where we have 1, 2 points that hit the double top breakout, or hit our resistance barrier, a third that didn't quite get there, and then the fourth finally took off. Now, again, it's easy for us to go back and look at this in the history, but it's not as easy to do it in real time. But let's go see if we can find another chart signal, which we have right here. This one's pretty clear. Triple top breakout. So if we were to look what signal Moderna is currently in, the last signal that it had was this triple top breakout, which was last month. And now what is happening is it's going up, down, up, down. And what we have forming is we have a triangle that's forming because we're not having a column breaking out above or below. So we're having this triangle that's going towards a single point. And what will be important to see is what way it goes from here. After it makes this triangle, does it go up or does it go down? Now again, there is a lot that goes into this company because they are working on the coronavirus vaccines. That is headline news. They are at the center of the news right now. So they're similar to Tesla. A lot of their price will depend on the news, will rely on the news cycle and the success of their vaccine trials. But what we see, if I had to say, is it in a buy or a sell signal? The most recent chart signal that we have is this triple top breakout back in November. So technically, it's on a buy signal. But something I didn't talk about today is the buy range, which is when after a buy signal you say, can I still buy? I don't need to give you a lesson to say that this is well outside of that buy range, and you can't really rely on this triple top breakout to be a buy signal at this point. But technically, this is in a buy signal. So that's an example of how we would read one of these charts. What I want to show you all is how you can find some of these chart patterns yourself. So what we can do is we can go here. Well, first I want to show you BPI. If we go up here to Charts and Tools and scroll down to Candle Glance, under Predefined Groups, we can get all of our sector ETFs, but we don't want those. We want our Bullish Percent Index. So now we get a bunch of crazy connect the dots. Give me my tic-tac-toe. Here we go. These now, by choosing under period, point and figure traditional, we get the bullish percent for all of the different sectors in the S&P 500. So for example, here we have, where's technology? Here's technology. Technology is currently in a column of X's at 80.82%. And we can see how it's done in the past, where it's had reversals, where it's had massive jumps, and where it's had corrections. The last thing I want to show you is if we go back to Charts and Tools, on the right side of the screen, under Predefined Scans, we now can see all of the different chart signals. If we scroll down to point and figure patterns, we now have a list of the 3,721 companies on a double top breakout, 519 on a triple top, so on and so forth. So we can see, let's go look at a bull trap, shall we? So right here we do have a bull trap. My son said, "Mom, are you playing tic-tac-toe?" It's tic-tac-toe with a lot of money on the line, yeah. So here we have our line. We have this single, I'm going to do green so it's not just, we have that X above the line, which would have been a double top breakout. And as soon as that happened, no, I don't want the line. I want an arrow. The price went down. So that is an example of a bull trap. But don't take my word for it. Go explore this yourself. Go to the predefined scans and look through all of the different chart patterns that there are. Because again, you can find the 69 companies in the market that are on quadruple top breakouts. And it's very interesting to get to see this, because it gives you a clearer idea of what these charts can look like. And if you are interested in it, using this to find potential companies that are going on buy signals or recently have gone on buy signals. Again, there's always more to the story than just one good day in the market. So I encourage you to still do your research and to think through all of these, because you never know what can happen. Prices can change at any time. Past results cannot guarantee future performance. Let me see if there is any other questions that I can answer quickly. So why did Pfizer not have as big of a jump as Moderna? Great question. Pfizer is a much larger company. Pfizer is a multi-billion-dollar company that doesn't just specialize in the coronavirus vaccine. They specialize in all sorts of pharmaceuticals. So their job, yes, the main focus of their company right now is in the coronavirus vaccine. But it is a very large company that the effects of this market boost, or of the kind of increase in their attention, it's not as large as a company like Moderna, which before they started working on the coronavirus vaccine was not a very commonly known company. This company's name got made because of their developments in these spike proteins and in in developing messenger RNA, which is their whole specialty, developing a cure, or rather treatment, for coronavirus. It's because of that their company has become famous. So a lot of their price is because of their successes and lack of failures in developing this vaccine. Pfizer was around for years before, will be around for years to come, and they are a pharmaceutical company, not a biotech company. So that is my very quick reason for why. Romulo is asking, what chart patterns does Juan de los Palotes favorite? The most important thing is the direction. You want to find things that are trending long-term over time, but have a reason for it. We like to find companies that have strong fundamentals, because then you know that chart signal is not because of some weird earnings report or whatever it might be. It's because the company has strong values and strong fundamentals and has a change in buying trends or habits. Well, I think that's all the time we have for today. Thank you all so much for participating, for asking amazing questions, and being part of these webinars. We will have one of our last webinars of the year next week. Kira and I are going to be having a lot of important stuff coming up here in late December. So next Friday will be a fun webinar in which I will talk a little bit more about a summary of what we've covered over the past 6 months together, because it's been almost 6 months with you all. So I want to cover some of the highlights from all of those lessons and talk about what we have planned for the future for all of you, because this is only the beginning. Past results cannot guarantee future performance, but what I can guarantee you is Sectors Made Simple is only getting started, and that this is only the beginning of what we have to share with you all, and the lessons and hopefully investments that we have to profit from with each other. Thank you all so much for joining us today. We will see all of you members for our Inversores en Sectores class on Tuesday and our members webinar on Wednesday. For everyone else, hope to see you next Friday. And until then, take care, stay safe, and see you all very, very soon.